Good afternoon, folks. We're here live with this all-star crew of care planning experts. I have my friends, Mark Boletsky, Shawn Britt, Anthony Mento, and Lily. Lily, we've known each other for some time, but I'm not even going to attempt the last name pronunciation on this call. So, this is quite an honor to have such a talented group. I want to welcome you to our presentation today called Next Gen LTC Planning. This is our first live broadcast from Saito in Philadelphia at the 30th Street train station. It's quite an attempt at advancing our technology efforts here at Life Brokerage. So, I first want to introduce our esteemed panel here. And again, we are so fortunate to have such a talented group with us. I want to just first showcase the opportunity here in care planning, and planning has really been evolving due to four forces. We're seeing longevity, labor shortages where we're taking Gen 2 and Gen 3 out of the workplace, liquidity needs, and legislation. So the goal today, and I've crafted about 13 questions that anyone in the care planning space would want to have the answers to. And I'm going to position those questions to our esteemed panel. We have some slides to go along with the discussion points. But we're going to ask this panel to break down how to turn some of these challenges into advisor-led opportunities. So without further ado, let's go around the horn real quick and just introduce our panelists and share a little bit about yourself. And I'll start here to my right with Shawn Britt.
Hi, I'm Shawn Britt. I'm with Nationwide. I'm from the advanced sales department, and I specialize 95% long-term care. Of course, I have to do life insurance because our products are attached to life insurance. But I've been doing this in advanced sales for 20 years now. I've been in the business for 30 years doing long-term care. And I travel the country and get to meet a lot of wonderful people and advisors and people like Anthony. And just so happy to be here. Thank you.
Thanks, Shawn. Shawn is a huge talent in our industry. She's done a lot for our industry, in particular in the care planning space. We will be glad to share a couple of her very impactful white papers that she's written over the years at the close of this meeting, to go along with our slides and some of the topics that we're going to discuss today. Waterlily, tax deductibility, premium funding. So there'll be a host of supplemental handouts that we'll push out along with today's recording. Lily, would you introduce yourself and say a few words?
Yeah, absolutely. Nice to meet everyone. I'm Lily. I'm the co-founder and CEO of Waterlily, where we built personalized AI to make the long-term care conversation relevant to any prospect, any advisor sitting in front of you. And we made it so simple so that whether or not you've had the long-term care conversation with the clients before, you're able to end-to-end have a really fantastic conversation with them. So looking forward to sharing more about that later. A little bit about my technical background. One is I founded the business because we navigated a personal long-term care event in my family. It was really devastating. And so I pivoted my career from aerospace, specialized in machine learning and AI, as well as healthcare, led product and engineering at early stage medtech IoT startups before founding Waterlily. So excited to be here.
Yeah, Lily, you have quite literally built the most impressive tech that coordinates the predictability of care planning, the need, the importance of care planning, the sequencing of the discussion that should take place, and pairing you with our two esteemed carrier partners here is a distinct pleasure. So, you'll be hearing much more from Waterlily in the near future, and we're fortunate enough to get in and start working with Lily at her infancy or her startup phase. But I have no doubt that her solution is going to explode into the market. Mark?
I'm Mark Boletsky. I'm from Security and Financial. I'm the Senior Advanced Sales Consultant there. I've been doing LTC planning for close to 30 years. I've been in the industry close to 40. So I have a huge depth of knowledge here, like Shawn. I am in the advanced sales area, so I do other things than long-term care. But I've been doing this for quite some time, and I too have had some long-term care issues within my family that I want to point out, what you need to deal with or how to deal with the sort of stuff. I'm also a certified grief counselor. So from that standpoint, I can help you through some of that stuff. So, thank you.
Thanks, Mark. Thanks for being here. Okay, so I think at this point, we're ready to kick it off with, the very first of many questions, right? We have 13 difficult questions to answer, and, I'm gonna start with Lily. And Lily, you'll indicate when you wanna use some of our slides as a prop, but first, I would ask you, how is Waterlily's AI-driven journey changing the entry point for long-term care planning?
So I'll answer it verbally, which is prior to Waterlily, the way that the long-term care conversation happened was usually when the prospect or client would say, "Hey, we just navigated a long-term care event for my parents. Can we think about, some insurance for myself or how I should plan for this topic?" And what the advisor would do is use averages, national averages, zip code calculators as their best way to try to personalize what the cost would look like, usually based on zip code, and tell the client, hey, this is what you could do in terms of here's 3.5 years of care. Let's look into a nursing home in your area. So it's about 10K. So do you have roughly about 350K to self-fund, or do you want to buy insurance for that? That was the gist of the conversation for folks that already understood how painful the event was. They could actually purchase an insurance product, no problem. But vast majority of this market, vast majority, are families that don't proactively bring up long-term care. And when the advisor does bring up long-term care proactively with national averages, generic averages, the client is just not moved to actually act on that, which one, I think affects the advisor's confidence in bringing up the topic such that it adds value to their clients, but also two, the advisor themselves questions, have we actually planned enough financially in the future to protect for this event? So that's where we change things, where instead of national averages, Waterlily pulls from our data set of over 500 million data points of families that we've been following for nearly 30 years on whether or not they had a long-term care event or not. And we have a short 3-minute intake form to ask, what do you look like sociodemographically, financially, medically, so that we can look at lookalike families that already went through the trajectory and showcase that trajectory to you, as Anthony mentioned, very methodically, very simply.
Well said. Lily, do you want to talk a little bit about the impact on families and how care planning is pulling folks out of the workplace, and how longevity and liquidity and family dynamics are being affected?
Yes, absolutely. So right now with long-term care, we see that less than 10% of families actually have some form of coverage on this topic, meaning that they usually pay out of pocket for this cost, which is drastically increasing and how unsustainable it is. Outside of us navigating that personal event, which I will lead into later, on average, every single household in the US will go through a serious form of long-term care event, which usually involves 2+ ADL needs, things like bathing, dressing, eating, showering, needs that you may already be familiar with your grandparents needing help with or your parents needing help with. And today it costs $250,000 out of pocket for a single individual, not even for a set of parents. And that cost is only growing exponentially due to growing healthcare inflation rate, but also because of advancing technologies, folks are living longer, but not necessarily healthier. And we can't rely on families in the same way that we did historically. And the consequence of that, if we wanted to go to the next slide, is without any sort of planning today, I wonder if we could. Perfect. Without any planning today, this is causing a devastation to our social safety net, Medicaid, in an unprecedented manner. So without any planning, already today, nearly 8 million Americans run out of money and end up going on the wait list, and 10% end up going on to the wait list, meaning those that run out of money and don't have access to financial resources to pay for care don't get access to care at that time, which results in homelessness and hospitalizations. But because of these growing cost factors for families paying out of pocket without coverage, what we anticipate seeing from first principles is that Medicaid is not at all set up to take care of that cost. Right now, the pressure and need on Medicaid is far outpacing the growth in its reserves, so much so that in 10 years from now, what we anticipate is that nearly 12 million Americans will run out of money applied to Medicaid, but without any change to the system, without any advancements from Waterlily or from experts in this field and in this table, we anticipate that 50% of those individuals that run out of money will end up on the wait list instead, which will cause an economic crisis that we've not seen before. And so that's what we're looking to prevent by building out this software to make it accessible and relevant to every single American household in the US and to expand the market in order to make it sustainable for everyone. So what I'll step into is a bit about why we're so obsessed with this problem. And it's because we navigated this long-term care event firsthand in my family when I was a lot younger. So previously, in a past life, I was on a fast track in aerospace from 12 to 16, was doing some work with NASA, went to college early for it. But when I was 16, my aunt was diagnosed with terminal stage colon cancer. And the important thing outside of the financial piece is just how devastating it was for us to navigate care from a physical burden standpoint, but also how it affected our relationships to not have that plan in place. And so with my aunt, who's a really integral part of our first generation immigrant family, she was diagnosed with terminal stage colon cancer, and post chemotherapy, she was so incredibly frail that we navigated 2.5 years of her daily long-term care needs. So it's not just an older age, but it can happen as a result of certain medical diagnoses as well. And so what came with those 2.5 years was deep devastation on, not only financially paying out of pocket because we didn't realize health insurance wouldn't cover this, and we nearly bankrupt ourselves paying anything and everything for her care. But most importantly, we stepped in physically despite everything else that we had going on work-wise or education-wise. But the most important aspect was how much it tore my family apart to navigate this without a plan in place, because navigating all those high stakes decisions about what her care would look like in such a short amount of time, it was inevitable that we would disagree. And so without that plan, we disagreed so often and so deeply that we haven't spoken to that entire side of our extended family in over a decade. And this was mirrored across hundreds of other families that I interviewed when I started up Waterlily, the exact same financial devastation and relational devastation as well. So bleeding into the second question on why we should sequence this conversation, we've seen it firsthand that there are many folks that vaguely know what long-term care is, but they don't know how to go about talking about it. If anything, I see so many advisors and so many families freeze up when they kind of talk about long-term care because they don't know where to start. They don't know, well, I've heard of nursing home and I've heard of aging at the home, or, us taking care of family members, but we decided to guide the long-term care conversation as simply as possible through what your care needs are going to look like before you think about funding, because those care needs and preferences create a difference of hundreds of thousands of dollars, if not millions of dollars, for much younger individuals to make those kind of care preference decisions once they see their need. And it also helps this conversation be anti-salesy in nature, because this really is about planning and putting the client's best interest first.
Yeah, one thing that jumped out at me, Lily, and this is where you've kind of set the table, is, long-term care used to be an emotional discussion. And recently, particularly as a distributor and in this fast-paced world that we live in, it's all about the numbers. It's how much does it cost, right? And I think what you're doing is help shaping that care journey before you even get into funding discussions. So, if you don't mind, Lily, walk us through the journey and how the software kind of sets the table, which will lead you into a financial discussion or an economic or premium discussion at some point, but only after you capture some very important details.
Yes, absolutely. So what we focused on is how do you set up the advisor of any skill set level, whether you've had the conversation or not, to have the best personalized long-term care planning experience that focuses purely on the need first and funding last. And so it's a simple 4-step process where we start with a 3-minute intake survey where we ask sociodemographic information, medical information, and financial information. It's about 60 questions that's logic gated intelligently, so that's faster. And so what we do with that intake form is we look at over 500 million data points, data sets of families that we've already been following to look at the lookalike families to then be able to showcase to you based on the families that look most like you, what is your unique likelihood, onset age, and then on this slide, not just stopping there, but also what is your unique duration of care? And I guess we'll go back really quickly. What is your unique duration of care? And this is where the education starts. So the prior slide on your likelihood and onset age sets the relevance of this topic. But then we step into what your unique progression of care needs are actually going to look like, which breaks down that duration into early care, moderate care, and full care. And what we showcase, if we go back really quickly, sorry, if we showcase in each of those care phases, not only how long you'll be in that unique care phase of needing help with 1 to 2 ADLs for early care, but we simply show you 2 options, which is at any single time, which is do you want to age at the home or into the appropriate needs-based facility. So you don't have to do any research ahead of time as the advisor. You're able to click on that preference. We predict it ahead of time based on the intake form preference, and we show you how that preference is linked to a dollar amount here. So it's no longer about selling them. It's actually about making transparent how the preferences lead to cost. And over 90% of individuals want to age at the home. So that's when we opened up the most powerful insight on our system, which is how family members by default step in for your care, whether it is a spouse, the children, or other family members. And we usually see clients reduce those hours dramatically down to 0 hours once they realize, oh, long-term care is not about being comfortable in retirement. It's actually about protecting my family members from taking on care that that would have otherwise happened if I did not see these numbers logically, ahead of me. And I know that my children can't. I know that Jane's going to be a lot older, my spouse. And so they reduce those hours. But when you reduce those hours, those go to professional hours. And on the right-hand side, if we increase professional hours, it increases the cost, but not because we're trying to sell them on a higher cost, because transparently, we need to allocate budget so that the family members don't have to step in. So the client is guiding and designing their numbers ahead of time. So then by doing this across all 3 basic care phases, we then can step into the 4th section. Next.
I'm just gonna maybe stop you right there for a second before we get into the funding. What makes, and you spoke a little bit about this on your data points, but before we get into solutions, what makes the Waterlily solution literally, 2/3 better or more accurate than traditional tools?
So this number, so this is just a matter of the data just proving it, the validation data just showcasing itself. So for each of the numbers that we share, we actually share the accuracy metric, and across some of them, it's actually way more fascinating to see how a number such as what is your predicted onset age compared to the average, and how accurate that is. So the way we validate our system, at least for the 65% accuracy standpoint, is we look at all those families that we've been following for nearly 30 years, and we say, let's actually look at the national average for you of when your start age is actually going to be and see how accurate was the national average at guessing what you looked like. As we, can intuit, it wasn't very accurate at all. However, if we predicted for each of those families what their unique age is going to look like, then that's where we were 65% more accurate than just using national averages in this case.
Nicely done, nicely done. So we've created awareness. We have completed an intake survey. We've discovered the needs. We've chosen the level of care who's going to help with care. We've predicted accuracy and with a high degree of probability. Now let's get to the fun part. How do we cover the cost of this, of this situation that, you know, I would suspect every single one of us in this room has experienced with a family member, at one time or more.
Yeah, absolutely. So what you'll see in the top right-hand corner is a very high projected LTC cost, which is just over $800,000 for John in his case. I believe he's likely in his mid 60s. So that's a pretty standard number, which is really high. It's not just today's dollars. We have to take into account the healthcare inflation on top of that to solve for the future dollars. But we didn't sell John based on our process on it's going to be $800,000 because most people just tell you to get out of the room. But that $800,000 is actually what John picked for himself when he chose, I want to age at the home. I don't want my family members to step in. Or actually, you know, when I have growing care needs, I'm open to going into assisted living facility or a full care facility instead of aging at the home. From there, the question now is how do you solve for that $800,000 as efficiently as possible? And so that's where the magic the financial features we have in Waterlily happen, which is we allow you not only to put in traditional LTC products, but there's many vehicles that could actually help solve for long-term care. We don't have a preference and we don't on what you would use. So you could actually model self-funding, you can model asset-based hybrid policies, traditional LTC, short-term care, even standard annuities to pay for that care, especially if someone would otherwise not get underwritten under insurance products. And the coolest thing is that when you add a funding, and it's insurance, most people don't understand insurance, especially the hypothetical illustration tables on what the hypothetical max is. And what we did instead is you could actually upload any policy from any carrier, any type of policy. Again, life with the rider, traditional LTC, hybrid, etc. And we read through that document in real time in under a minute. And we pull out all the key terms of that policy that tells us how you're paying into it, as well as how it would hypothetically pay out for you under, you know, home care, facility-based care, and whatnot. So that if we went back really quickly, so that we line up the terms of the policy to your unique long-term care scenario that we predicted for you. So that instead of hypothetical max benefits and 20, 30 pages to sift through, we show you, for example, this MoneyGuard Fixed Advantage product, how much that cost is going to be, as well as what is that unique LTC payout for John in this case, like how would it most likely pay out based on its terms, which then you could see it's not actually based on hypothetical max benefit. And also that policy, which may have a max benefit of $1 million, $800,000, it actually may have a much lower LTC payout compared to nationwide product or compared to secure and care product because the devil's in the details, but the daily max and inflation and etc. So that is why you should upload multiple products, whether it's nationwide or secure and secure care, to see how would that product uniquely pay for your long-term care needs and how much more efficient would it be compared to self-funding in this case, which is on the right-hand side, we show you under projected ROI. So instead of 30 pages, it's a single line item to explain this vehicle, which then makes it more concrete why it may look like a better financial decision than doing nothing on this topic or than self-funding. We package all of this up, if we go to the next slide, really cleanly into a one-page PDF report. So whether the client decides to do something about it today or in the future, at least you could have a no-pressure conversation where instead of saying, we should spend an hour on this, just ask the client, do you want to take 3 minutes to just learn what your needs are? And then we could decide whether or not we dive into it or not. And you could always download that one-page PDF report for them to take home to marinate on if they prefer.
Nicely
So
done, really well done. You know, this again is probably the most impactful tool I've ever seen when it comes to care planning. And, you know, there's no coincidence that our partners in the room here, could certainly fill the need of some of these, the transfer of risk strategies within Waterlily. We have a unique partnership with Waterlily, where you can access different subscription discounts. And if you're active in the business and make certain commitments, potentially even a subsidy, to utilize and test Waterlily for a 6-month period. We have seen a host of different application for it. We visited with a money manager in Marmora, New Jersey, a couple weeks ago, and he said, there's no reason why I wouldn't provide a complimentary design to every single one of my customers. I'm gonna send every single one a link, an introduction to the potential solution, complete a needs analysis, start talking to them about care, assign a junior investment advisor in our firm to spearhead this project. And I think our clients are gonna love it, and it's gonna create a whole bunch of opportunity for us to engage in care planning. Lily, anything else to add on utilization and how to use it and how to access through the folks at Life Brokerage? And we'll certainly share that in our follow-up, but I just want to make sure you don't have any parting thoughts here.
Yeah, absolutely. So it's very simple. It's very simple to sign up, but if you just go ahead and reach out to any of your dedicated person at Life Brokerage, they have all the details. So the moment you just share even a quick email that says, I'm interested in Waterlily, what does the price look like? How can I get access to that subsidized or sponsorship plan? They should already have the links, be able to share that with you. And of course, when it comes to onboarding, it's really short, it's really simple. All we do is watch you just, sign up. And then for you to build out your first client plan. What we've actually seen on our system is the moment you build 2 to 3 sample clients by yourself, each which takes just a few minutes, you'll then quickly get a sense of, wow, that's really intuitive. And I'll also share that 75% of our users and majority of our super users today are wealth advisors. And so we've been really excited about Waterlily as a part of that financial planning suite that they have.
Yeah, and as far as utilization, just the last thought here. Should you access through the Life Brokerage ecosystem, Lily's team alerts us to a completion or a client completion of the intake survey, which then signals to us, let's go drop some very relevant proposals into the system so that the financial advisor or the insurance professional get to review the outcome of the care plan and the client's intake form. Those solutions are sitting in the portal and able to create an immediate discussion. And it creates a very harmonious presentation to the customer. Thank you, Lily. Great job.
Thank you.
So as we move forward into the next series of questions, there's been this age-old debate as to whether you have to be in a certain demographic or net worth or liquid asset range to quote unquote make sense to transfer the risk and purchase insurance. I think what you'll see and what Lily kind of just proved out and what you're going to hear from Shawn is that it's really for all shapes and sizes, right? If you're looking at pure ROI or some of the money matters discussions that Shawn bring to light, it just makes sense. I mean, we've had quite literally multiple billionaire families go in and acquire asset-based long-term care on everyone in the family, ages 35 to 65, just as a prudent planning tool. It isn't the old age, traditional long-term care rates, go up on you and use it or lose it. There are some more sophisticated strategies that will speak to the economic advantage of transferring this risk with a cost recovery mechanism. Shawn does an amazing job and has continued to do an amazing job over the years in articulating these points in white papers. This will be the first white paper that we share with you at the close of today's meeting before the weekend. But I'm going to turn the next 3 questions to Shawn and try to get to the heart of, Shawn, we'll start in who's buying and why should they buy. And for starters, let's talk about why self-funding, which Lily just proved out, mathematically, is often a double loss strategy for wealthy clients.
Well, you know, a lot of affluent and high net worth clients, sometimes they believe they can self-fund, even if the advisor mentions it to them, say, oh, we plan to self-insure. Or sometimes the client goes to the advisor or their attorney or their CPA will say, well, you don't need that. And they'll talk them out of the insurance. What people don't understand is everybody needs long-term care. It's just for different reasons. So the middle market, we know why they need it. We want to make sure they don't end up depleting everything they have to pay for care. But for the affluent and high net worth, there's other reasons. One of them is, let's think about it. As an advisor, you're usually the person calling your client, but when do they call you? When the market's down. That's when you get inundated. So, you know, in the last couple months, advisors have been getting a lot of phone calls, people panicking. Nobody likes to see their statement go down for any reason. And when you tell them, well, great, can you afford to self-fund? Yes, but that doesn't make it a good idea. So what's gonna happen when you have an event where you have to start taking out large amounts of money, because you're not gonna stay at that average place the middle class people stay at. You're gonna go to expensive places that have the top level care. It could cost as much as $35,000 a month. If you stay home, the average cost right now is $250,000 a year for 24/7 care. So when you're pulling that money out, your account is not only going down, but that's money that's forever lost, and it's a double loss because I can't grow it back and I can't grow it forward. You don't like when your portfolio is going down. So what I suggest is that we create a fund off to the side, not tied to the market. And we're going to do it with insurance because it's preset, it's guaranteed. We'll have it paid for, and then that's over here, ready to go at a moment's notice while I work with your portfolio. If the market's up, it keeps going up. If the market's down, I bring it back. The point is, we don't want to use your portfolio as your long-term care funding.
Shawn, that ties in really well with everything we preach about sequence of return risk and, timing the market, not timing the market, and volatility buffer solutions and guaranteed income, right? This even compounds the problem when you're drawing down in a negative market or you're following a down market, right? Not only are you extracting principal from your portfolio, but you're also locking in your losses, right? And
Exactly.
I think my partner Adam uses the term dollar cost ravaging, right? You never get the opportunity to recover because, typically what follows a down market is an up market. So if you're selling into down markets and you're taking those shares off the table in fund long-term care, it's almost a triple loss strategy in a down market, right? So very, very astute. To piggyback off that, you often say, and we hear you say, insure the portfolio, not the person.
Mm-hmm.
Can you explain that framing and how advisors can use that in their discussion?
Sure. So, when you think about that higher net worth person, they actually will tell you, well, they're not going to need long-term care. And they're going to tell you, well, I go to the best gym in town. I have a personal trainer. I get all my food at Whole Foods. It's all organic. Okay, great. They can afford all of that. That's really nice. That actually makes them more likely to need long-term care because sick people die quickly, healthy people linger. So, my father, right up to the last breath, he was mentally sharp as a tack, but he died very quickly. My mom, on the other hand, had a very healthy body, but she had dementia, and it took a long time for the dementia to wear her organs down because she had been so healthy. So my parents were that typical sick people die quickly, healthy people linger. So they actually are more likely to have a longer long-term care event. And we want to insure their portfolio. So instead of saying, well, yeah, you may never need it, but what if you do? Then go back to the double loss, the dollar cost ravaging, and explain, here's what's going to happen to your account. What I want to do is insure your don't worry about you. Let's worry about your portfolio. Let's insure the portfolio so that if something does happen, then your portfolio is, we're gonna just do what we always do, and if it doesn't happen, we're gonna use the product where you don't lose any money. Your estate is gonna get that money back or more, depending which product we use, will depend how much more they get, but the point is, take it off of the person, because they don't believe their person is gonna need care. Talk about protecting their portfolio, they're gonna be a lot more interested in hearing about getting their portfolio protected.
Yeah, I purchased at age 45, and two motivating factors were, hours I would be burdening the children or potentially my spouse, and portfolio protection.
Mhm.
It really wasn't about me, it was no longer about premium, it was no longer about, does it make sense, should I self-insure? They're just two emotional decisions that I don't want to affect the portfolio, and I certainly don't want it to affect my wife and kids.
Well, that's exactly what, I have 3 policies, I'm about to buy my 4th. And that's very similar reasons. I wanted to protect what I have.
Yeah, well, if you're interested, Mark will sell you one. Shawn, how does, and we see this so often, just getting back to the family dynamic, but how does long-term care insurance reduce family conflict around care? And act as, let's call it the peacemaker.
Sure. Well, when we think about wealthy people, it doesn't matter how wealthy these clients are, there's always kids that are worried about their inheritance. And we think about, with the middle class family, we know what the dissension is. They worry about it's usually the daughter who's put in charge. And somebody's always disagreeing with her decisions about the care and whatever. But even with the wealthy, the daughter puts mom in the nicest place. And the brother on the other side of the country is like, why are you spending so much money? Blah, blah. And it really is boiling down to, he knows what's left getting spread 3 or 4 ways. And, he doesn't want his inheritance whittled away. When you have insurance paying for it, the daughter can say, what are you worried about? We have insurance. Insurance is paying for this. Let me do what I'm doing for mom and take care of her. And it kind of done. Argument's over. So insurance literally, and I don't want to say these kids are greedy, but there's always one in a family that isn't quite as up to speed as the other kids.
Yeah.
And having that insurance to be paying for it kind of settles that person down and gets them to kind of stop with, this poor sister has enough on her table, she doesn't need to be fighting with her siblings.
Yeah.
And that having insurance pay for things is just the perfect line. Don't worry, we're not using mom's money, we're using the insurance.
Yeah.
Conversation ended.
Another motivating factor to acquire the coverage by
Mhm.
mom and dad to keep that harmonious relationship between their children.
Mhm.
And not be the reason for friction.
Exactly.
Well said. So shifting gears a little bit, it's a hot topic that's kind of kicked around our industry, and what's next in state and federal, long-term care mandates. And I never thought I would see it in my lifetime, but I did see it happen in the state of Washington. Just to keep the audience up to speed on what's happening in this space, how should advisors frame private long-term care in light of mandates in Washington and potentially New York and California?
Well, just to give you an update on what's going on with the states, everything's on hold in California. The fires in Los Angeles sort of sucked the air out of that legislation. The reports have been done by Oliver Wyman. Everybody has copies of the reports, but right now California has a couple of issues. One, the rate, I think across the country, we've seen homeowner and car insurance rates go up, but it's been particularly brutal in California. And their legislation is now worried about getting people who lost their insurance, getting their homeowner insurance back, and getting some controls on the costs, and getting Los Angeles rebuilt. Next year's an election year. Nothing's gonna happen in an election year for obvious reasons. So a lot of us and my sources that I have out in California don't believe much is gonna happen until 2027. Now, in that report, California is looking at opt-out opportunities, but we don't know yet what the requirement will be for the policy to have an opt-out. So what we're really, and Commissioner Lara has been very clear, if you promise opt-outs, you're gonna be in trouble. You know, just so, talk to your California clients about long-term care, buy what their need, try to meet their needs with what they can afford, and keep your fingers crossed that if something happens in the future, their policy will qualify. That's all you can do. But it's just important, you know, for people to wait to see if they would get an opt-out, it's just silly. They're gonna get older, they may become uninsurable. You need to just talk to them now and tell them that the best thing you can do for yourself is have this coverage. New York, State Senator Shelley Mayer, lovely woman. She's had her third attempt to get a bill in New York. Word on the street, though, is the governor, who's running for reelection, doesn't want any new taxes. So I'm not sure if I was on a panel with her last week, and she's just lovely. I asked her about that, and she just kind of shook her. She says, I'm gonna make this work. So, you know, we'll see. What we do know, though, under the current definition of long-term care insurance in the state of New York, only traditional policies will qualify for an opt-out. Unfortunately, only about 7% of sales are traditional policies. People don't like taking that risk of the use it or lose it. People who buy traditional policies, only 5% put the return of premium on it because it's so expensive. So it's sort of you know, you want the opt-out, but you have to buy a policy you don't want to get the opt-out. So it's a little discouraging there. There's also the federal bill, the WISH Act, that's been introduced by Congressman Tom Suozzi, also of New York, Democrat from Long Island. And I've been working on that as well. That would be a federal bill. There would not be any opt-outs. It will be means tested in some capacity. Right now, his bill is showing a means testing of 1 to 5 years, depending on your wealth. The benefit, especially for wealthier clients, is not going to cover the type of care they want. They still need a policy. They're gonna need a policy to cover the period of their waiting period, as well as to supplement what the bill might provide for them, if they make it that long to get to, you know, through their elimination period. So, right now, the congressman is looking at different ways to fund this act, and we'll see what he comes up with. Right now, the act on paper is saying a 1 to 5 year elimination period before you get any benefits. There would not be any opt-out with that program.
Yeah, I think the states and the federal government see the writing on the wall, right? You can follow some very prominent economists, and, you know, ITR, for example, is predicting a recession in 2030. And one of the driving forces of that recession, along with our rising debt and inflation, is that our baby boomers are going to exit the workplace. They control most of the money. They are going to get sick. They are going to require a lot of care, and it's going to be very expensive. And in 2030, there are actually going to be more baby boomers than kids ages 0 to 18. And it's going to be a tremendous stress on our systems. So, you know, something is going to break. Politically, we're not sure when and how, but I think the writing's on the wall. You know, thank you for sharing. So as we move into our funding discussion and, you know, different ways to fund, you know, I think we've proven the math. We've demonstrated that, folks of all different wealth classes should be considering. We've quantified the need, we've moved the needle on emotion, we're looking to protect portfolios and children. Let's talk about how to efficiently fund these strategies. And Mark, you've done a lot of work in this area, and the first question I'll pose to you is you know, walk us through your 3-step framework for long-term care premium deductibility. There's some buzz around this discussion, so let's get to the heart of it.
Sure, thanks, Anthony, on that. By the way, if you haven't read the WISH Act, or at least the beginning of the WISH Act, The government knows exactly what the crisis is. They just don't have an answer for it. And the answer is going to be taxation. There will be taxation, it will be additional taxation, and it will be high taxation. And we have a reprieve right now while the Trump administration is in, till the end of the Trump administration. After that, all bets are off on lower taxes. So at Securing, we've been calling it the Great Reprieve at this point. But when it comes to long-term care, deduction, the word deduction to us in the industry, the tax industry, is a good thing. To the IRS, it's a bad thing, because they are looking for dollar. And so the three steps you look at when you look at things is what part of the long-term care contract is deductible. So you have to look at it first from an individual standpoint, because individuals can deduct. You also have to look at it from a company standpoint, partnerships or individual or corporations, C corporations and S corporations. To make it real simple, best taxation occurs with a C corporation to an employee. Okay, from there on, it goes downhill as far as deductibility and as far as what is included. At Securian, we let's go to the next slide here. We work with what I call the chart. Now, to allow you to remember the chart, I have to take you back to the 80s. There was a show called Fantasy Island. Fantasy Island, there was a tall guy in a white suit, black tie, and a little guy, Hervé Villachez, who was tattooed. And every day, every episode starts the same way. Look, boss, the plane. Now, I'll say to everyone on the line, look, folks, the chart. Because your deductibility isn't the premiums that you pay. Rather, it's what the government says you can deduct. The chart. So every time you think of this from now on, think of the chart. Okay, so let's take a look at an itemized deduction. Now, first thing, I'm a tax attorney, so I talk in numbers. 7702 capital B. That is the definition of long-term care insurance. It is not 101. Same exact definition. Everything looks the same, but 101 is not 7702B. One of them is deductible, 7702 capital B. One of them is not deductible, 101. Okay, so the first thing is it had to be a qualified expense. It had to meet the definition of 7702, 7702B. Here's the thing about 7702B, capital B. You can't have any cash value in the contract. The government, when they created long-term care legislation, thought like a term provider. That you would just pay the pure term costs, that nobody would save their own money in a life insurance contract to pay the costs. They didn't think like that. You know what? Nothing's changed. You go back to the 80s when long-term care started to be coming out, or even early 70s. It was thought of as a term type deal. They could only pay for a short period of time. One thing I need to remind you, 60 months. Now that's a long time. 60 months is 5 years. That's longer than I was in college. Some of us have actually been in college maybe longer than that. I mean, the law school, it's 8, but 60 months. In order to get on any government program, you gotta wait 60 months. Okay, so this is important, and this itemized deduction for medical expenses is a carrot. It is not the sale. Let me be real clear about that. You'll never sell an LTC policy based on the tax deductibility of it. You will sell it on everything that Shawn said and everything that Lily said. This is an emotion, and what Anthony said, this is an emotional sale. This is a sale of preserving the family. It's a control issue. it's a smart move, but it has to start 5 years in advance. 60 months, because it rolls. You get turned down from nursing homes. Once had a guy who said he owned a nursing home. I said, can you get in? Okay, so here's Mike, he's 55, great age. His annual LTC is $5,000, but we go back to the chart. And the chart said the age-based limit is $1,800. Therefore, his deduction is limited to $1,800. As The Rock would say, if you're a fan of professional wrestling, okay, it doesn't matter what you deducted. This is what the chart says, $1,800. For Mariana, age 72, her LTC premium is $5,000. Her age-based limit is $6,020. Guess what? She doesn't get the $6,020 because she didn't pay $6,020. She only paid $5,000. So therefore, her deduction is limited to $5,000. So again, we look at our current interest, we look at above the line deductions, we look to adjusted gross income, then we look to the standard deduction or itemized. So right now in the United States, our standard deduction for married filing jointly is $30,000. Our single is $15,000. You have to get over that amount in order to deduct the expenses, because itemized deductions say that medical expenses, which LTC premiums are limited to 7.5% of adjusted gross income threshold, okay? So from that standpoint, if you have $100,000 income, the most you can do is 7.5% for deductibility. So which clients will get the itemized deductions? Generally going to be older with their age-based limitations. They'll have large amount of out-of-pocket medical expenses. They'll live in state with high state taxes. They'll also be making large charitable gifts, and they may be paying large amounts of mortgage interest because they're itemizers. Okay, next one here.
The itemizers.
The itemizers.
That's the key, it's age-driven and the
Itemizer,
itemizers.
right.
Now, shifting gears here, Mark, there is some relief using HSAs to fund long-term premiums. So what should the advisors on the call know about how to use HSA assets to fund long-term care premium?
Remember what I said, I'm tattooed, okay? The chart. The limitation is coming from the chart. So too many people think that they can get their entire premium out of their HSA account. You can't. You can, you better have a chunk of money in some other expense that you're taking out the HSA for. Now, you can look at HSA expenses, Google it. There are hundreds of HSA expenses. I don't have enough time nor enough energy to actually cover all of the types of expenses. But just like everything else with long-term care, there are limitations as to what can actually be deducted. So here we got Larry, he's age 67. He pays a $15,000 annual premium for 7 years for Secure Care 3 policy. Again, Secure Care 3 is a 7702 capital B product. He has $30,000 in his HSA account. The LTC portion of the premium is $7,747.43. His age-based limit is $4,810. Larry's HSA pays the $4,810. Larry pays out of pocket $10,190. If he took that all out of the HSA, he has to have expenses for $10,180. My advice to Larry is don't take the entire premium out of the HSA unless you have those sort of expenses. Now, is it probable that he has those kind of expenses? Yes, he'd have extreme medical expenses, hospital expenses, things like that, usually falls in, but don't take out too much, because if you're under the age of 65, you got a 10% penalty tax plus ordinary income coming out of that HSA. So you want to be careful when giving advice on HSAs. Yes, you can take it out, limit it to the chart, or make sure that the other expenses associated with that premium are covered by some other deductible amount. Other tax implications. Well, our LTC agreement will not be subject to income tax if it's up to the per diem limit. That's $420 in 2025. That's per day. That's what per diem means. If it exceeds the per diem amount, then you must show documented qualified LTC expenses. Okay, which means you have to have a bill. You have to have some form of documentation. If you're paying a child or someone to take care of you, you have to submit a bill. Okay, this is not loosey-goosey stuff. The IRS will audit and you will have, where's the bill? And if there's no bill, there's no deduction associated. Remember, IRS doesn't like deductions. We tax attorneys do. But again, our policy can be a MEC. You don't have to worry about MEC because if it comes out for tax-free, it comes out tax-free. 1035 exchanges are permitted. The government gave us a wonderful bill a couple of years ago in the early 2000s. It allowed the exchange of, we'd always done 1035 exchange, life to life, life to annuity. Okay, I always called it, you could always go from a less taxable vehicle to a more taxable vehicle. Right? You could never go annuity to life. However, you can now go annuity to hybrid life. Okay, now if you do that, okay, you have to have a company that does that sort of arrangement, and you have to isolate the cash value component. Okay, so you will be doing an annuity and the long-term care contract separated from the two and paying into it over time. That is what will happen under the 1035. It's a partial type 1035 exchange, which is how you have to do this. So you have to be very careful on this. It can be done, it is allowable, but you have to do it correctly. Because if you don't, the gain gets forced out of the contract and it's taxable.
Yeah, I'll also add, Mark, that a technique that many of our advisors have been using with both of our carrier partners in this room is to bring seasoned cash value policies over to either Securian or Nationwide, and then direct traffic as needed.
Correct.
You can fund a Care Matters or a Secure Care, you can fund a guaranteed income annuity, you can fund a guaranteed VUL. Once the money's in-house, then our carrier partners can direct the allocation of those funds and how the amounts that to be allocated. So it's been a really effective planning technique for folks who have used cash value life insurance as a wonderful accumulation tool, have moved into the next phase of their lives through different maturity and different needs-based planning, and now have LTC guaranteed income in the forefront and kind of make that trade from the cash value component to more needs-based protection vehicles.
One other thing to note, if you're going from an annuity without long-term care to an annuity with long-term care, the annuity controls the taxation. So you are stuck with annuity taxation, annuity to annuity with long-term care. I always caution people who like to sell annuities that, you do have the annuity result when you do that, whereas with life insurance, you have the life insurance result.
Yeah, we're going over time here, but I think this is really important to finish this out and go beyond our 1 o'clock stop. This has been quite difficult for me, like Coach Sirianni here in Philadelphia, to spread the ball around to Saquon Barkley, AJ Brown, and Devontae Smith. I mean, this panel is filled with all-stars. So we want to make sure that we, this probably could have been a 2 or 3 hour workshop, but I think we can take this another 10 minutes and kind of get to all the important parts that we need. Arguably, this could be one of the more important parts when it comes to funding. Mark, can you compare for me an S Corp and a C Corp and strategies that business owners are using to fund long-term care through their entities?
As I said earlier, C Corps are kind of the nirvana for long-term care planning because C Corps separate the entity from the owners. So there is a complete separation of the entity from its owners. So C corporations are taxed from $1 at 21% currently. That might actually go down to 20% and maybe 15% if you're a domestic manufacturer, according to the latest bills that are out there. But again, we have 21%, and everybody is an employee for purposes of a C corporation, to the extent that they've been added as an employee and they withhold taxes and things like that. If they're just taking a dividend off of it like an investment, that's different. But typically, if you're working for the company, if you're a titled officer, if you're any type of person like that, you have got to be an employee from that standpoint. So as an employee, you can, in fact, deduct 100% of the premium from the C corporation and deduct the long-term care expenses, not from your side. Again, going back to an individual receiving the amount, he's going to receive the excluded amounts as not as LTC, but the included amount, the rest of the executive bonus, as we'll call it, is going to be taxable. So typically what the companies are going to do is they're going to do what we would call the double bonus. Okay, which is going to be to pay the tax on the tax. And you get to that number by taking the difference between the LTC, which you don't have to pay tax on, the leftover, and then multiplying by the reciprocal of the recipient's tax bracket, that person's tax bracket. So we can look at a case study here. Again, we got Nancy and Paul. This is a C corporation. They're both employees. Paul, unfortunately, is not an employee. He's just a 20% owner of ABC Corporation. Okay, so we have a difference, right? They want to provide secure care 3 for Nancy in a valid class. They want to pay premiums $20,000 for 5 years. She's a female, age 60, non-tobacco, underwriting. This is all in the thing. You can see that with Nancy, we'll include of the $20,000, $5,109.46 is in income, $10,000 in premium paid over the years. And you can see the premium waiver for long-term care agreement, the acceleration for the long-term care agreement, the extension of long-term care agreement, and the long-term care inflation protection amount. You can see the actual adding up of that amount on the annual premium. You have to exclude that amount and then pay the tax on the difference.
So to simplify for the folks on the call, the only component that is included in income is the component dedicated to the face amount attribute of the policy.
That is correct.
Any health-related attributes are forgiven from income or exempt from it.
That's correct. So that is exactly the way to say it. And we'll see with Paul, who was our next person, again, same exact setup, same exact policy, all set up, but because Paul wasn't necessarily an employee, the business got no deduction for him. Okay, because he wasn't set up as an employee. He includes the whole $20,000 income. Over time, you see what the deductions are, but they did not get a deduction because Paul was not an employee. He's a shareholder. He's a board of director person. So the key is when you're doing a corporate setting or anything like that, you have to ask the question, is this person an employee? A lot of times you're going to get some crazy answers. Okay, one of the easy answers is, well, you better hire this person. Okay, that's the easiest thing. What does the person do? Well, you make a job description for that person. They need W-2 income. Okay, you also need a valid class. So you just can't give long-term care to everyone across the board. You've got to pick and choose, just like non-qualified deferred compensation. You have to have a select group of management or highly compensated employees for the most part. Now, that being said, you're a little looser with long-term care than you are with non-qualified deferred comp, but still, the basics of it, look around $135,000 of earnings. That's about the cutoff limit. You can go down a little bit lower if the company itself doesn't have that many $135,000 people. There are some cases out there where the top hat group is defined as the top 10 to 15% of the company itself. So if the company's got mom and pop and they're only earning $50,000, that's the top wage earner, you're covering mom and pop at $50,000. Though we look at 130, but in larger corporations, that's where you're looking.
Let's talk a little bit about pass-through, because that's the
Yeah.
vast majority of our.
Yeah, and unfortunately, 90, around 96% of the company is pass-throughs of some sort, including sole proprietors, LLCs, taxes, S corporations, LLCs, taxes, partnerships, LLCs, taxes, limited partnerships, all of the above are pass-through entities. So again, we're gonna get a deduction from the company. So the S corporation is gonna be as compensation. A partnership is gonna be as a guaranteed payment in the 700s, and the sole proprietor is gonna be compensation. So you're gonna include both life and long-term care portions, so then the entire premium is gonna be included, okay? However, if you have itemizers, okay, you're gonna be able to itemize, and if they don't itemize, then you might be able to look at their HSA if they have a high deductible healthcare plan. So you have to ask the question, do you have a high deductible healthcare plan? And do you have an HSA? A lot of times you're gonna get the answer, I don't even know what high deductible healthcare plan is. I have Obamacare, right? You get that answer once in a while. You gotta plow through that, okay? And find out if it's a high deductible healthcare plan. If you sell that sort of stuff, good thing, good client to have, then set up an HSA for those people. Here's Bruce. He's 47, he's employer owner of XYZ Corp and S Corp, has 2 employees, he's a more than 2% shareholder. Okay, back with me, the numbers, 2% means something, okay? The government treats people who have more than 2% shareholder of an S corporation poorly. They treat them as owners, and therefore they're not really employees. He wants to provide secure care for himself and his employees. XYZ is willing to pay $10,000 of premiums for 15 years. 6-year benefit duration. Again, we look at the case study here. We can see the deductions for each of them. We can see the spread of all of the premiums here, and you can see the lesser of the annual deduction or the LTC premium. You can see that everyone here is gonna get, for the most part, they're gonna get the chart on no matter what they're paying. So there you get that plus that, and it gives you the day one, 671,667. At age 85, you're looking at over $2 million of potential coverage because of the $10,000. It's a spectacular employee benefit. Often overlooked. I think now is the time to really look at long-term care as an employee benefit, whether you're a C corporation or S corporation or partnership. It's just you have to understand the taxation. And with that, I think.
Well, just one more here, Mark, what's the key to setting up this valid employee class for?
Again, we start at compensation. We look for titles. So any of the O's, CEO, CIO, EIEIO, whatever, just look for a title. Then you're going to rank compensation, looking for the top 10 to 15% of the covered compensation. Okay, and then you're going to install what we would call the typical executive bonus type arrangement, where you're going to pay a bonus, whether it's a straight bonus where you net the difference and they pay their own taxes, a single bonus where you bonus them the tax, or a double bonus where you bonus them the tax on the tax. Either way, it's going to be an executive bonus type arrangement, which we're all familiar with. And they're going to use those funds to go out and purchase their long-term care. I typically like it that way. I don't like when the employer just sends a check directly to the insurance company. Okay, not that I don't dislike it, it's just easier to have it on the individual side, because then they know and they value the coverage that they have. They received it and they make that premium payment, and they know it's a premium payment. I myself, I can tell you, when the company pays for it, it's like, it doesn't feel the same as when I have to stroke that check. And every time I stroke that check, I think about 60 months. I think about my mother in the hospital. I think about all the other people I've known that have gone into the hospitals. And it reminds me of why I bought the insurance. And it's important. We all talked about it. It's about preserving the family. It's about preventing animosities. It's about the one who's in control is spending too much of mom's money. all of that gets avoided when you have the insurance. And that is key for valid employee groups, but remember, the employees are people too. They need to be counseled. They're individuals, they may have other needs, so it's good for you, okay?
For sure. All right, as we bring it home, we're gonna bring Lily back. And we're gonna just kind of wrap and question 12 and 13 are gonna be for each one of the panelists. I guess we'll start with Shawn. Shawn, what's one great question to open the LTC conversation with the client that you would be asking if you were point of sale?
Instead of a question, I like a statement. So the clients in your office, maybe they've come in to do an annual review of their account, see how their retirement plan has been, where it's sitting, do we need to make some adjustments? And while they're there, I would say to Mr. and Mrs. Smith, while you're here today, I want to discuss how to keep you in your home as long as possible, should you start needing a little help. Because those words, long-term care, people immediately picture a nursing home. And they'll say, well, I don't want nursing home insurance, because they remember their mother or their grandmother buying nursing home insurance. So don't use the words long-term care in the beginning, just let's talk about how to keep you in your home if you start needing a little help. And they're like, oh, well, what do you mean? And then you can kind of go from there, but by positioning it that way, they don't put the walls up for you to have to start breaking down. They're ready to hear more of the conversation.
I like that. Mark, one great question to open an LTC conversation.
I use dates. So I basically say, do you remember 2001? Do you remember 2008? And they'll say, yeah, it wasn't a real good time. And then you ask the next logical question and somebody else answered, and somebody already asked it. It's like, what happened to your portfolio? Okay, and it dropped. I said, well, I use it for estate taxes and I use it for LTC. I said, you realize that the way things work in this world is that you have that drop automatically, whether you have a long-term care event or whether you die. Because the IRS is waiting there and the states are waiting there for 40 to 45% of it if you're wealthy. I said, if not, you're gonna end up with long-term care. I said, and that's gonna eat up a quarter of your portfolio, $250,000 to $500,000 of your portfolio will disappear off the face of the earth. I said, as long as you understand that, we can have a conversation about insuring that risk and insuring your portfolio, as Shawn said.
Yeah.
So that's
Date planning.
big bad dates.
Lily, same question.
Yeah, definitely. What's actually been really fascinating as a comment is we see advisors that can have the verbal conversation, do the production. The hardest cases, they just throw Waterlily at it. So they don't always use this for every single case, but the hardest ones are like, well, we're gonna throw Waterlily at it. So what they normally go with, and I'll just go with the hardest case, which you could go with the easiest case for, which is just asking a client, hey, have you heard of Waterlily or have you done any long-term care planning yet? Because if they answer no to any one of those, you could just tell them like, look, I don't want to take up an hour of your time. Could you actually just take 2 to 3 minutes to fill out this intake form? Because I want to understand what your future costs may look like together. And then we'll see whether or not we want to have a conversation. And once they fill out the intake form, very likely they'll say, well, I want to look at my results. If they're looking at the results, then they're going to want to do the planning. So just taking it bite-sized pieces at a time is great. So just ask them, have you heard of Waterlily or have you done, and have you done any long-term care planning? So whether they say yes or no, no one's going to say no to 2 to 3 minutes of filling out an intake form.
Well done. Very nice shameless self-promotion there, though. All right, last question. The content that we put together at Life Brokerage is never a Life Brokerage commercial. Is to create actionable, immediately implemented strategies within your client base or your centers of influence. So, I guess we'll close with this question and I'll come back to you, Shawn. What's one thing every advisor here on this call can do this week to move an LTC case forward?
Well, it doesn't really matter what their wealth is, but if they've kind of been stalling on this case and you're trying to get it to go forward, I would call them up, or if they're coming in, ask them while they're sitting there, I want you to write out where you want your money to go when you pass away. Give me a list. Have them write it out. Now say to them, if we don't get this policy and you have to pay for long-term care out of pocket, who are we crossing off that list? That is gonna be a big aha moment, you know, and for the super wealthy people who are gonna spend $1 or $2 million on their care, it could be crossing off the children's hospital donation or whatever. For the middle-class family, it may be meaning nothing left to help the grandkids through college or whatever. But everybody has a list, and something's gonna get crossed off if they don't have a policy to pay for this.
Nicely done, Shawn. Mark, same question?
Go to a nursing home and take somebody out for lunch. I don't care who you take out for lunch, hopefully somebody who's working at the nursing home, grief counselor, someone like that, and get to understand it from the counselor standpoint and from the whole process of long-term care. Because once you understand what is going to happen to that family, if it's happened to you and you've gone through this, that's great. If you haven't, you have to go through it virtually, so to speak. Taking someone out to lunch and talking to them about what do they do for a living, how it affects and things like that. Understanding that thing is the most important thing you can do. Because once you understand what the end is, the means all become a lot easier. And you just have to be able to convey that. And as Shawn had said, people, when they hear the word nursing home, they are terrified. I was when I walked through the doors. I thought it was gonna be the worst place in the world. It was actually pretty cool, you know, as I understood it. But I took my counselor out to lunch and we spoke and everything like that. And I got to understand, you know, their life, how they live, you know, what is required, what the care is. You know, these are things people don't naturally understand. You have to almost live it first and then convey it to them. And that helped you close every case because you're empathetic.
Thank you. Lily, what's one thing every advisor here can do this week to move an LTC case forward?
So, 0.4% of Americans over the age of 50 have some form of long-term care protection coverage. On Waterlily system, which you could get for free for 2 weeks to try it out, we actually see a conversion of 100x or an 11,000% increase on sales, whether it's annuity, life, or long-term care, to actually run that client through our system. And when they end up self-reporting back in terms of the production they're able to do in that 30-minute conversation. So what you could do today is just honestly sign up for the software. It's a really simple sign up process. You get to meet someone that's nicer than me, Evan, my co-founder, and in just 30 minutes, he'll just say, okay, walk through, build out a client, and it's so intuitive from there. And you can even onboard a client or two this week to have them fill out the intake form. And the data shows they're going to find it to be the coolest experience that they've ever seen and the most personalized planning for long-term care that they've ever gone through. And so we've received really positive remarks in that case, and it shouldn't cost a dime to even do this this week or even next week.
Well done. So 13 questions asked, 13 questions answered. I want to again thank our carrier partners here, who you're not seeing on camera, Derek Bullen and Jess Delela, securing the nationwide. I want to thank my panelists for joining us, Lily, Mark, Shawn. I mean, again, this was an all-star cast. It was really tough to share the football over an hour, so we took this, 75 minutes. But I think it's extremely valuable. Again, this recording will be made available to everyone who registered. Thank you for those who hung in for the extra 20 minutes. Shawn's white papers, copies of the slides will also be distributed. Reach out to your life brokerage representative for more information on Waterlily. We'll certainly share some additional information on how to connect with Lily and team. And I want to thank you for being with us. I wish everyone a happy Memorial Day weekend and safe travels back home. And this will conclude today's webinar. Thank you so much.
Thank you.